David, you slice and dice this. I want you to speak to Jerome Powell right now. Is the deflationary vector, is it in force, and will we stay with disinflation into 2024?
Well, I think the disinflation trend, Tom, will be the primary trend. We're going to have a bit of a bump, though, in the next month or two because the CRB has taken an 8% jump since the end of May for the reasons that you folks were talking about. And the question is, how the Fed's going to treat that and whether it's going to be temporary or permanent. This run-up we've had really across food prices in the commodity markets and also what's happened with oil coming off the bottom. Mm-hmm. If this was happening with a 4.5% to 5% unemployment rate and we had excess supply in the economy, not a problem. But at a time of full employment, this bounce we've had in commodity markets and in the context of the wage settlements we're seeing, I think has to be on the Fed's mind. So I would say that the primary trend is going to be towards disinflation into the next 12 months. But I would say that the next couple of months is going to challenge that view.
Are we beyond the pandemic? Are we doing traditional economics now, whether you believe in ISLM dynamics or you believe in factor dynamics, whatever, microeconomic foundations, whatever it is? Are we beyond pandemic analysis?
I don't think so, Tom. I think that we're still seeing a lot of the after effects. It's one of the reasons why, look, yesterday, nobody seemed to care too much that the Conference Board's leading economic indicator declined for the 15th month in a row. It's already gone down enough and far enough from the peak of December 2021 that the recession should have started. The inverted yield curve has been more than a year. It's very deep. The dispersion across all yield curves would be telling you that the recession should be starting. And we have this debate as to whether or not there's even going to be a recession. And so what's happened is that this was the Energizer Bunny. The gift that kept on giving were those stimulus checks from the Biden budget buster in March of 2021 and those excess savings, which historically Americans would spend half and save half. But we live in a much more narcissistic society today, right? I don't remember before this cycle, like you're asking me about is the COVID effect behind us, the worst of the COVID health issues behind us, but the COVID effects on the economy. I mean, we're developing new acronyms like YOLO, you only live once. So all the stimulus got spent, and that's what's basically clogged up the monetary channel from what the Fed has done to the real economy. And that might be ending right now, but it's one of the reasons why people calling for recession, like yours truly, have been frustrated, is because of the lagged impact of all that fiscal stimulus, which was a product of the pandemic.
What's interesting about this, John, is, you only live once. Rosenberg's going to see Barbie twice this weekend.
Supporting retail sites.
I'd bet against that.
David, I want you to dive here into my book of the summer, Blanchard and the Rstar debate. Blanchard feels that over time we will return to some form of quiescent Rstar. John Williams has staked out the high ground, saying we will return to Rstar. Others go the other way. Are we going to be in a 2%-ish Fed range out 5 years, 10 years? Or does David Rosenberg have to set to a legitimate societal reflation?
Well, and I think you're referring to 2% funds rate in nominal terms as being that baseline. And Tom, what's very interesting is that, through all the pandemic and all the distortions around the pandemic, that the Fed never once has changed its long-run estimate of where the nominal neutral funds rate is. It's been stuck at 2.5%. The work that's been done, normally Rstar refers to the real neutral rate, and let's assume that we get to that holy grail of 2% inflation. And then you have John Williams. By the way, our work has corroborated his work that there's a risk that Rstar in real terms goes negative in the years ahead. And that's supported by what? Well, what did COVID not change, or the policies around COVID not change, is aging demographics. And aging demographics has been and remains a deadweight drag on the equilibrium.
John tells me every day. Continue, Mr. Rosenberg.
Yeah. And the constraints of excessive debt is another consideration. And then we had something, this has been wonderful for the growth stocks in the tech sector. And it seems as though, NVIDIA back in May with that, truly, bombshell earnings report almost felt like Pfizer Monday, back in November of 2020. I'm not going to say this is bigger than the internet, but it's certainly bigger than 3D printing, and it's going to have monumental impacts on structural shifts to the labor market, labor-saving technology. That, again, is going to be, I think from a labor market perspective, a significant disinflationary force, just like the internet was, not on the same scale, but it doesn't have to be on the same scale to be a truly disinflationary force and an impact on Rstar down the road.
David, I just want to squeeze in an extra question on that then. And this is really sort of like out there thinking down 10, 20 years. But how on earth are politicians going to deal with this, David, if we start to see that kind of job replacement from this kind of boom?
Well, it's going to be a big problem because with the aging demographics comes with that higher dependency rates, and that puts added pressure on fiscal finances at a time when governments around the world have been so profligate on the spending side. So this is going to be a very big fiscal problem. Some people say the only way out of this is we have to inflate. We have to inflate a way out of this debt problem. But the problem with inflation, and the reason why Jay Powell has been fighting inflation, and with cover from the White House, is that inflation is a tax on the poor and the elderly. So when people say, well, we have to solve the debt problem, with inflation, no, because it creates other social problems. Ultimately, we're going to have a revamping of the entire fiscal system, means testing on entitlements. And the bottom line is that this dirty 5-letter word called taxes are going to have to go up. And that's why I think that, when you're taking a look at why have bond yields not soared? Even with what's happened with foodstuffs and energy in the past few days, the Fed about to pin the funds rate at 5.25 to 5.5, the stock market booming. Why isn't the 10-year note have a 5 handle? Why are we at 380 on the 10-year note with all this? So the bond market's telling you something. It comes back to Tom's initial question. The bond market is telling you something about that disinflationary future. So I think that in terms of how governments deal with it, I think this era right now that we're seeing a fiscal rectitude is going to have to switch towards fiscal tightening down the road, because this is not sustainable. I'm looking at this thinking, if you told everybody what was happening with the stock market, fiscal deficits, everything that we're talking about right now, we have to ask the question, the biggest anomaly is not what the stock market's doing, guys. It's what the bond market is not doing.
Interesting.
What's that message?